Welcome to Time in History. I'm Professor Bill. In 1929, Americans believed the economy was unbreakable. The market kept rising. Banks were trusted. Wealth felt permanent. Then, in a matter of hours, billions vanished. What followed was not just a crash. It was hunger, foreclosure, unemployment on a scale the nation had never seen. Tonight, we step into the day confidence died. Look closely. In the summer of 1929, Wall Street felt unstoppable. Stock prices had been climbing for years, and few people questioned why. Clerks, shop owners, even farmers were buying shares on borrowed money. The market wasn't just a financial system anymore. It had become a national obsession. Confidence was everywhere. Doubt was nowhere. On October 29th, selling turned into panic. Millions of shares were dumped in a single day. Prices collapsed so fast that the ticker tape fell hours behind reality. Investors stood helpless, watching their savings vanish line by line. By the closing bell, billions of dollars in paper wealth had simply disappeared. The crash did not stay on Wall Street. Within months, fear reached ordinary neighborhoods. People lined up outside banks, demanding their savings in cash. But banks did not keep enough money on hand for everyone. When withdrawals surged, institutions began to fail, one after another. By 1930, the damage had spread beyond finance. Factories began cutting shifts, then shutting down entirely. Assembly lines that once roared with noise fell quiet. Men showed up for work, only to find locked gates and notices posted on the doors. Industrial production fell sharply, and with it, paychecks vanished. By 1932, nearly 1 in 4 American workers was unemployed. That number meant millions of households without income. Savings were drained. Furniture was sold. Homes were lost. For many families, the crisis was no longer about stocks or banks. It was about whether there would be food tomorrow. Soup kitchens became a daily reality. Lines for bread stretched down entire city blocks. Men in worn coats waited quietly, hats in hand. Many of them had steady jobs just months earlier. Pride was swallowed in exchange for a bowl of soup and a piece of bread. As foreclosures increased, families lost their homes. Across the country, makeshift camps appeared on empty land. They were built from scrap wood, cardboard, and sheet metal. People called them Hoovervilles, blaming the president for their condition. These were not temporary shelters. Many families lived there for years. Between 1930 and 1933, thousands of American banks failed. Some collapsed quietly overnight. Others closed with crowds gathered outside the doors. Depositors waited, hoping their savings would be returned. Most never saw that money again. Trust, the foundation of banking, evaporated faster than the cash itself. As the economy collapsed, the land itself turned against farmers. Severe drought and poor agricultural practices created massive dust storms across the Great Plains. Fields dried, crops failed, entire farms were abandoned. Families packed what little they had and headed west, chasing rumors of work that often did not exist. Children grew up in the shadow of uncertainty. Many left school to help support their families. Some lived in cars, others in temporary shelters. Malnutrition became common in areas hit hardest by unemployment. For an entire generation, stability was not a memory. It was something they had never known. In 1933, Franklin D. Roosevelt took office amid widespread fear. Banks were closing across the nation. Confidence was broken. His administration launched the New Deal, a series of emergency programs to stabilize banks, create jobs, and restore trust. It did not end the Depression overnight, but it marked a decisive shift in how government would respond to economic disaster. The collapse did not stop at American borders. Global trade shrank dramatically as countries raised tariffs and protected their industries. Factories in Europe slowed. Banks in Germany failed. Unemployment surged across continents. What began as a crash in New York quickly became a worldwide economic breakdown. Many expected recovery within months. Instead, the crisis stretched on for years. By 1933, the economy had contracted severely, and unemployment remained painfully high. Entire communities adjusted to a new normal defined by scarcity. The Depression was not a single event. It was a prolonged struggle. Behind every statistic was a family. Homes were repossessed. Farms were auctioned off. Personal belongings were sold for a fraction of their value. Pride, once tied to work and independence, was tested daily. The Depression was measured in percentages, but felt in empty kitchens and unpaid rent. The Great Depression reshaped financial regulation, government policy, and public trust. It changed how banks operate and how markets are supervised. Yet the underlying lesson remains fragile. Markets depend on confidence, and confidence can vanish quickly. The day the American economy collapsed was not just history, it was a warning. Many investors had bought stocks on margin, with borrowed money. When prices fell, brokers demanded immediate repayment. If investors could not pay, their shares were sold automatically. That forced more selling, which pushed prices down even further. The crash fed on itself, accelerating with every margin call. As banks failed, credit disappeared. Businesses that relied on loans to pay suppliers or workers suddenly had none. Storefronts closed quietly, one by one. Without credit, commerce slowed to a crawl. An economy built on borrowing found itself unable to breathe. By 1932, evictions were no longer rare. They were routine. Sheriffs arrived with papers in hand while neighbors watched from the street. Furniture was carried outside and placed on sidewalks. Farm auctions drew crowds who bid on land their owners had worked for decades. Loss stopped being private. It became something witnessed. Across rural America, auctions became common weekend events. Tractors, livestock, kitchen tables. Everything had a price. Families stood quietly as strangers bid on the tools that once fed them. It was liquidation on a national scale. When assets are sold to survive, the future shrinks with each item gone. In cities, new scenes became familiar. Men sold apples on street corners for a few cents each. Others sat along curbs, waiting for day labor that rarely came. Suit jackets grew worn, shoes thinned. Urban life slowed, not because people stopped moving, but because opportunity had stopped appearing. In March 1933, with panic still spreading, the federal government took an extraordinary step. Banks across the country were ordered to close temporarily. The so-called bank holiday was meant to stop the bleeding. For several days, Americans could not access their accounts. It was a dramatic reminder of how fragile the system had become. To counter unemployment, large public works programs began hiring on a massive scale. Young men joined the Civilian Conservation Corps. Roads were built, dams were constructed, parks were developed. Government spending replaced missing private investment. It did not end hardship overnight, but it offered structure where chaos had dominated. By the mid-1930s, there were signs of improvement. Some factories reopened. Construction resumed in parts of the country. But unemployment remained high, and confidence was fragile. Many Americans had work again, yet they no longer trusted the system that had failed them. Recovery was visible on paper. Stability felt less certain in daily life. In 1937, just as the country hoped the worst was over, the economy slipped again. Industrial output declined. The stock market fell sharply. Unemployment rose once more. The setback reminded Americans how unstable recovery could be. The Depression was not a single collapse. It was a prolonged era of uncertainty. Economic distress fueled political instability abroad. In parts of Europe, unemployment and financial strain strengthened extremist movements. Trade barriers divided nations. Cooperation weakened. The global economy never fully stabilized during the decade. The Depression did not directly cause war, but it reshaped the world that entered it. When war production accelerated in the early 1940s, factories roared again. Massive government contracts revived industrial capacity. Millions found employment in defense manufacturing. Economic output surged in ways unseen since the 1920s. For many historians, it was wartime mobilization, not policy alone, that finally ended the Depression. Even after growth returned, the memory of loss lingered. Those who lived through the 1930s saved carefully, avoided debt, and distrusted speculation. The Depression shaped an entire generation's view of money and risk. Its economic damage lasted a decade. Its psychological impact lasted much longer. By mid-1932, the stock market had lost nearly 90% of its 1929 value. What had once symbolized unstoppable growth now reflected collapse. Trading volume thinned. Speculation faded. Investors who survived the crash rarely spoke about it. The market would not return to its 1929 peak for another 25 years. In parts of the Midwest, farmers organized to resist foreclosure. They attended auctions in groups and bid only a few cents, returning property to original owners. It was quiet rebellion, born of desperation. Communities tried to shield each other from total ruin. The crisis was economic, but survival became collective. In 1932, thousands of World War I veterans marched on Washington. They demanded early payment of promised bonuses to survive the Depression. They built camps near the Capitol and waited. When negotiations failed, federal troops were ordered to disperse them. Images of veterans forced out by soldiers shocked the nation. In response to repeated bank failures, sweeping reforms were enacted. The Banking Act of 1933 separated commercial and investment banking. The FDIC was created to ensure deposits. For the first time, Americans were promised protection for their savings. Trust would have to be rebuilt, this time with regulation. As men lost industrial jobs, many women entered or remained in the workforce. They worked in offices, garment factories, and domestic service. Public opinion was divided. Some argued jobs should be reserved for men. But for countless households, women's income meant survival. The Depression quietly reshaped gender roles across the country. Photographers, writers, and artists documented the hardship. Images like Migrant Mother captured the human face of the crisis. Government-funded art projects recorded daily life during the Depression. Culture became a witness. The era was not only endured, it was preserved in memory and image. After the emergency reforms, banks gradually reopened. Customers returned carefully, some depositing only small amounts at first. Lines formed again, but this time to restore accounts, not withdraw everything. Trust did not come back overnight. It returned slowly, transaction by transaction. The Depression permanently altered how Americans handled money. Families saved more and borrowed less. Clothing was repaired instead of replaced. Large purchases were delayed or avoided entirely. Frugality became a virtue shaped not by choice, but by experience. While major industries slowly recovered, small businesses faced a tougher road. Many never reopened after the crash. Local shops struggled with reduced consumer spending and limited credit. Main streets changed in lasting ways. Economic recovery did not reach everyone equally. The crash transformed the relationship between markets and government. The Securities and Exchange Commission was created to oversee stock trading. Financial transparency became a public concern. Speculation without oversight was no longer tolerated. Capitalism remained, but under closer supervision than ever before. Those who grew up in the 1930s carried its lessons for life. They distrusted rapid wealth and avoided unnecessary risk. Saving became instinctive. Waste became unacceptable. Even in later decades of prosperity, the memory of collapse shaped financial decisions. The Depression became part of personal identity. By the numbers, the scale was staggering. Industrial output fell nearly in half. Thousands of banks disappeared. Unemployment remained high for nearly a decade. The Great Depression became the benchmark against which all future crises would be measured. When markets trembled again in 2008, historians immediately invoked 1929. The collapse of major financial institutions revived old fears. Governments intervened aggressively, determined not to repeat the mistakes of the 1930s. The comparison was imperfect, but the memory of the Great Depression shaped every decision made. During the early years of the Depression, the Federal Reserve struggled to respond effectively. Later analysis concluded that tighter monetary policy worsened the downturn. Modern central banking was shaped by that lesson. In future crises, liquidity would be injected quickly, an institutional memory born from failure. Before 1929, many believed economic expansion could continue indefinitely. The crash shattered that assumption. Boom cycles were no longer abstract theory. They were lived experience. The idea of too big to fail proved fragile. Prosperity, it turned out, was never immune to collapse. After the Depression, personal savings were treated almost as insurance against uncertainty. Households built emergency funds. War bonds and conservative investments became common choices. Financial caution replaced speculative enthusiasm. The culture of saving was not theoretical, it was defensive. The Depression did not strike every community equally. Minority populations and already impoverished regions suffered disproportionately. Relief programs were uneven in access and distribution. Economic collapse magnified existing inequality. Crisis reveals vulnerability. It does not create it from nothing. Economic policymakers today still reference the 1930s. Stimulus packages, deposit insurance, and regulatory oversight are rooted in that era. The Great Depression became a case study in what happens when confidence collapses. It remains both a warning and a framework for response. The crash forced Americans to question the structure of their economic system. Congress held investigations into market manipulation and banking practices. Executives were called to testify. The idea that markets could regulate themselves without consequence was openly challenged. For the first time, capitalism itself faced national scrutiny. Beyond policy and data, something quieter changed. Confidence in upward mobility fractured. The belief that hard work guaranteed stability weakened. For millions, the Depression reshaped what security meant. Economic trauma became personal memory. Many who survived the Depression rarely spoke about it in detail. They saved quietly. They avoided debt. They taught their children caution without always explaining why. Scarcity shaped habits long after prosperity returned. Silence itself became part of the legacy. Every major downturn since has been measured against the 1930s. Recessions are compared to it. Market corrections are weighed against it. The phrase, "since the Great Depression," remains a benchmark in economic reporting. Its scale defined the outer boundary of collapse. The Great Depression was not just an economic event. It was a reminder that systems built on trust can unravel quickly. Prosperity may feel permanent in the moment, but confidence, once broken, takes years to rebuild. The day the American economy collapsed was not only about lost wealth. It was about discovering how fragile certainty can be.